What's good, self-direct investors? I hope you're all doing great, and I want to welcome you back to my channel. If you're new here, my name is Jordan. I'm the mind behind Make More Capital, and today I'm coming at you with some news Schumer dropped yesterday, plus a special breakdown of the 280E tax burden that these cannabis companies face. So before we jump in, if you enjoyed this video or you learned something, please just leave a like on it as it really helps out my channel. And then, of course, if you want to learn how to take advantage of this generational investment opportunity, make sure you subscribe below so that you don't miss any future videos, and then there's plenty of content for you to go back, rewatch, and educate yourself with so that you can take advantage. And yesterday, Schumer has changed his vocabulary from shortly to soon, dropping this, saying that the federal cannabis legalization bill will hit the Senate floor soon. Straight to the Senate, which is great. Love that. He's talking business. Now, Schumer says that the bill, we just recapped that. So let's highlight a little bit from yesterday. During a press conference on Sunday, Schumer talked about how a large majority of the Democrat caucus wants to end prohibition, and it's also getting support from some places you wouldn't expect, such as the libertarian right. He also noted that voters in conservative states such as South Dakota approved legalization initiatives last year. I'm going to put this bill on the floor soon. It hasn't been introduced yet, the majority leader said, adding that he's been working on it with Wyden and Booker to draft the reform measure. Once it is introduced, it will go right to the floor. So let's hope when he says soon, let's hope that's by the end of the month. And just to reiterate that as we are creatures of habit, I'm looking to see if history repeats himself, as in 2018, Schumer did announce that he would introduce legislation to decriminalize cannabis at the federal level. Obviously, that didn't go through, but and I want to point out that it'd be better if he were to just introduce it today or on Monday or even after 420, just because that day does involve a lot of news fluff talking about stoners gathering to consume cannabis, obviously highlighting the old stereotype and not reality that we're in, but just wanted to point that out. So look out for that coming in the next few weeks, hopefully by the end of the month. But when he says soon, he's been one of the few politicians that keeps his word over time. So let's hope he can do that. Now, this newly released IRS document details efforts to collect taxes from cannabis companies under 280E. So this one's pretty heavy, and when we go through it, we realize the double standard and how much more issues cannabis companies face than any other retailer in the US. But I do want to point out that although 280E is a political weapon targeting cannabis companies, there may be a fix, highlighted by Nick Richards, a former IRS attorney who now works for himself. So he knows the ins and outs, and it's just good to know that we have people, professionals on the ground working for us that also know that this is unfair and that for the greater American good, they need to make this change happen sooner than later. So before we jump into the infographic, I just want to highlight this is the introduction to a special series revealing key elements of more than 200 pages of internal IRS documents obtained by MJBizDaily related to the enforcement of Section 280E of the Federal Code and the cannabis industry. So the documents can be accessed here if you want to read them. There will be links below as well. But let's explain this high tax burden of 280E. Congress added Section 280E to the Internal Revenue Code in 1982 to prevent any company that traffics in Schedule 1 or Schedule 2 substances, such as marijuana, from taking standard business deductions. So this shows us how cannabis companies are impacted as opposed to comparatory to a traditional retailer. So let's assume both companies, a cannabis retailer and a traditional retailer, make $1 million in revenue. Now, to make that $1 million, there are costs that expand over time, like rent, utilities, insurance, and maintenance. These are your fixed costs. And so let's assume that they each have the same amount, $100,000, $100,000, $250,000 adds up to $300,000. So one thing to point out, cost of goods sold here, both retailers can adjust their taxable income based on the cost of the goods that they're selling, including wholesale cost, delivery, and storage. But standard businesses can deduct these fixed expenses, whereas cannabis retailers cannot deduct these expenses. So after going through the revenue, the fixed expenses, and then the cost of goods sold, we have their taxable income. And the reason that the cannabis retailer's taxable income is $500,000 as opposed to $200,000 is because they cannot deduct this $300,000 in fixed expenses. So that gives them a higher taxable income, and then they also have to pay a 25% tax burden, which just increases the amount that they're paying on top of their taxable income. So income after tax and expenses is considerably lower, half that in this example, for cannabis retailers compared to traditional retailers. So that seems to be the situation, and obviously, yes, this is unfair. And the good news is that the more awareness and the further this spreads, the more eyes are on this, and the sooner change might come, and hopefully there's call to actions in order to initiate this change. Now, the Internal Revenue Service has been fixated on the state legal cannabis industry for more than a decade, largely because it has been extremely lucrative for the federal agency to audit cannabis companies. So no wonder they don't want to change it. They're making a lot of money. And we'll get into that as we read through. The IRS audits of cannabis businesses have generated far more in unpaid taxes or revenue per hour for the agency than audits of mainstream industries such as automobiles, up to 4 times more in certain cases. So ridiculous. The tax agents also have become more adept over the past decade at enforcing Section 280E of the Internal Revenue Code, which prohibits the use of standard business deductions by any company that traffics in federally controlled substances. Section 280E commonly results in state legal cannabis businesses paying upwards of 80% to 90% in federal tax rates, and sometimes as much as 100%, which is just ridiculous. Makes my blood boil, but the point is, we're way past where we were before. And a lot of these companies, especially the big MSOs, are making a lot of profits despite this. So just imagine how much more success and how much more money and profit that they will keep once this is repealed in time. So we have to be patient and just trust that the professionals will do their work. And it appears the IRS is unlikely to alter its stance toward the cannabis industry anytime soon. As the U.S. Department of Justice made clear in a February legal filing with the U.S. Supreme Court, President Biden's young administration has no intention of backing off from 280E enforcement. In short, the IRS has studied and refined its methods for examining cannabis industry tax returns and, in the process, cracked down on tax deductions such as employee wages by cannabis businesses the agency believes are prohibited by law under 280E. That in turn has resulted in almost non-existent profit margins and or multi-million-dollar federal tax bills for many cannabis companies, a trend that will likely continue until the government legalizes cannabis. And so this assessment is based on an analysis of 212 pages of internal IRS documents obtained through the Freedom of Information Act, thank goodness for that, requested by Marijuana Business Daily. So to get a professional analysis of the documents and their significance, MJBizDaily shared the documents with 3 attorneys who have extensive cannabis industry and federal law tax law experience. Most of the documents have not been made public until now. They offer an unprecedented glimpse into the inner workings of the IRS and its cannabis dealings, as well as hints of what cannabis business owners can expect the next time the taxman knocks on their doors. It's a peek behind the curtain, Denver-based tax attorney Nick Richards, a former IRS lawyer who has worked with cannabis businesses since 2013, said of the documents. The documents detail how IRS agents have reported for years that auditing cannabis companies is a better return on investment for Uncle Sam than comparable audits involving mainstream industries. In one series of industry audits in California that concluded in 2015, the IRS found the average cannabis industry audit resulted in $2,788 per hour in taxes owed to Uncle Sam, compared with an average of $686 per hour for other businesses that were also considered good audit targets. It clearly indicates that the IRS is interested in auditing the cannabis industry. What we see in here from the results is they feel like they're getting a good bang for their buck, Richard says. In fact, at least 2 IRS agents suggested in written reports that the tax agency should start a national program to broaden the scope of cannabis industry audits. So they want to increase their team or their task force that is going after these audits, which is insanely ridiculous. But that just goes to show that their abuse of power is becoming a bit too extensive, and it's good that we're getting eyes on this now. The IRS Office of Public Affairs answered certain questions from MJBizDaily for this series, but left many others unanswered. The agency did email the following statement. The IRS recognizes the cannabis industry is growing and is assessing the training needs of its employees, determining the appropriate compliance actions, and increasing taxpayer awareness. The IRS wants cannabis business owners to be educated on their tax obligations and provides information for them to be compliant. It's important to note that federal courts have consistently upheld IRS determinations that state-compliant cannabis dispensaries have taxable income. Yes, well, this is because you are in bed with the federal courts, so that's no surprise here. Now, in the meantime, the IRS audits and tax bills remain an ongoing challenge for cannabis businesses. Protracted legal battles have erupted over 280E, with the U.S. tax court typically siding with the IRS. Because again, what's the point of going against it when it ultimately brings in money for your team, which is the government that you're representing? So it's very sad. So let's go through some of the highlights. The documents offer a wealth of additional details on how the IRS views and handles both 280E and cannabis industry operators. For example, they provide never-before-disclosed information about how the IRS has been training its agents on the ins and outs of the cannabis industry through PowerPoint presentations, as well as a previously confidential 30-page participation guide that instructs IRS agents on the finer points of auditing cannabis businesses. The participation guide and training materials include suggestions on how to obtain as much information from cannabis business owners before they hire attorneys to represent them during audits. How can we take advantage of these companies better? Let's figure it out. Such a shame. The most effective audit technique for obtaining income information is the interview with the taxpayer. The participant guide instructs IRS agents. So this is someone who's opening their own cannabis business. Imagine they get they get a visit from someone from the IRS. They don't have a lawyer yet, and they accidentally answer a few questions. That's sort of the example. As many taxpayers hire representation after the initial interview, it may be the only chance they have to talk directly with the taxpayer. The documents also provide details on at least 4 extensive cannabis auditing programs known as Compliance Initiative Projects, which began in 2010 and were run by the IRS in California and Colorado. The first California CIP was even expanded in 2013 to include cannabis companies in Arizona and New Mexico, based on the IRS documents because both states had operational cannabis dispensaries by that point. The CIPs focused on cannabis company compliance with 280E. The release of the documents follows a federal watchdog report by the Department of the Treasury last spring. That report, written by the Treasury Inspector General for Tax Administration, foreshadowed a likely uptick in cannabis industry audits by the IRS. But it also criticized the agency for not making public the participant guide obtained by MJBizDaily. Very fair. Similar documents, compiled for other mainstream industries and identified by the IRS as audit technique guides, are commonly shared with the public so taxpayers can more easily comply with their federal tax obligations. If you run a cannabis business, but you don't get the tax sheet, you can't fully prepare to do your taxes properly. So then you're going to face a bunch of issues. And then, saved by the tragic pandemic, the corona situation, meanwhile, might have given the IRS some cover as to why it hasn't yet released the participant guide or any other written policies for guidance for the industry. An IRS attorney said in January that written guidance on 280E compliance for cannabis companies has been put on the agency's back burner for now in light of the ongoing health crisis, which makes sense. They should have other things to focus on as opposed to trying to take advantage of an industry because they know they're going to make more money because of it. That makes MJBizDaily's publication of the documents even more timely for cannabis businesses hoping to avoid running afoul the IRS. And it's worth noting that many of the documents are years old and don't necessarily reflect recent legal cases or precedents that have been set by court rulings in cases such as California, one involving San Jose Wellness, in which the subsidiary of Oakland-based Harborside lost a fight against the IRS and was ordered in February to pay $4.2 million in back taxes. There's also Harborside's loss in a 2018 U.S. tax court ruling, yet that outcome represented a partial victory because the company wasn't forced to pay $11 million in penalties despite losing the primary challenge to the constitutionality of 280E. Another 2018 ruling from a case started by alternative healthcare advocates in California also reinforced the IRS's position on 280E. Alternative Health had attempted to avoid 280E by hiring a management company to run its operations. The result of that case was a broadening of the scope of companies to which 280E applies, aside from only plant-touching businesses. None of those cases are mentioned or addressed in the documents by MJBizDaily. That's important stuff, Richard said, noting that the absence of these cases in the documents suggests that the IRS is still likely updating its 280E training and reference material guides for agents. To San Francisco-based attorney Henry Wachowski, who represented Harborside and several other cannabis companies in landmark U.S. tax court cases and legal battles with the IRS, the fact that the agency has kept its cannabis industry participation guide secret is yet another example of the double standard under which the industry labors. Here, once again, we're being discriminated against, Wachowski said. What's so secret about this? The IRS is still evolving on 280E, just abusing their powers in whichever way they can, trying to stay ahead. Mind you, above all, the documents underscore that the IRS has been dedicating significant resources, probably taxpayer money, to ensuring that as many cannabis companies as possible pay as much taxes as the agency can require under the legal umbrella of 280E. They also highlight how the IRS has been evolving over the past decade in the way it approaches and deals with state legal cannabis companies. The situation isn't without irony. The documents detail an effort by the IRS to compel an industry, one that is illegal under federal law, to obey U.S. tax laws and pay its taxes. To drive the point home, multiple PowerPoint training documents make it clear that the IRS attorneys seriously weighted the option of seizing cannabis from companies that were behind on their tax bills. So imagine that. The government is then going to take the cannabis and maybe try to sell it themselves, although it's federally illegal. Wouldn't be the first time the CIA moved drugs, maybe that we know of since the 80s. Although the practice of seizing and selling off assets from tax-delinquent businesses is within the norms of IRS procedures in mainstream industries, it's likely eye-opening to many in the cannabis sector that federal agents would even consider trafficking of a federally controlled substance. That possibility was ultimately dismissed primarily because the IRS wouldn't be able to sell the cannabis it seized. The training documents also contain suggestions which Richards and Wachowski said would be seen as absurd to anyone with a working knowledge of the industry, that IRS agents could calculate revenue generated by indoor cannabis grow operations by examining their utility bills. Unbelievable. Trying to find whatever way they can to weasel money out of them. What that underscores, however, is how federal agents have struggled to figure out the correct balance for dealing with two things: the disconnect between federal law and the many states that have legalized cannabis, and an industry that historically has been averse to keeping sound financial records for fear such documentation could be used against them. This is a good example of that tension between state and federal illegality that the IRS is struggling to make the best procedures and policies they can, said Catherine Allen, a tax attorney with Wachowski Law. The result of this series will dive further into analysis of the compliance initiative projects, the audit participation guide, and IRS training materials for its agents, as well as what all of this might portend for the future relationships between the tax agency and state legal cannabis companies. I'm pretty sure the federal government was never supposed to have this much power, and it was the states that were supposed to maintain most of it. So that's a breakdown of the burden and what the IRS is trying to do to keep these companies down. Mind you, the best part is that they have thrived regardless. That is what you need to remember. So we're going to go through now how the 280E we know is a political weapon targeting these companies, but that there may be a fix thanks to Nick. Now, just a bit about Nick. Nick Richards, a partner in the tax practice group at Greenspoon Martyr in Denver, advises cannabis stakeholders in tax and regulatory compliance matters. He has been a tax attorney for more than 20 years, beginning his career with the IRS. And this story is part of that series. So how does Nick, someone with integrity, feel? I'm angry. There are too many examples of innocent people suffering because of our nation's politics and prejudices. The Internal Revenue Service's audit program and enforcement of Section 280E of the Federal Tax Code are another example. In fact, Section 280E was born of politics at the height of the war on drugs in 1982. Later, when California legalized medical cannabis in 1996, the war found a partner in the IRS. The Clinton administration even issued a memo that same year pledging to use Section 280E to destroy legalized cannabis. So imagine that. The intent was there. They did not want it to thrive, but you cannot bend reality for so long without it snapping back at you. And as Marijuana Business Daily showed us this week, the ripple effects of that policy still reverberate today. But we're closer than ever to repealing this. I got to remind that. And when Nick was an attorney for the IRS, he was involved in this fight to shutter abusive tax shelters and promoters. The IRS audit program documents that MJBizDaily obtained show that the agency is using the same tactics against the cannabis industry that we use against tax cheats, targeted audits, criminal investigations, compliance initiatives, senior revenue agents, and coordinated collections. The documents show the government's huge coordinated effort to penalize the industry and utilize its ability to disallow deductions to the fullest extent possible under federal law. But the one thing the documents, the IRS court victories, fail to show is the difficulty the IRS faces in collecting the phantom income tax. Phantom income tax, which is Section 280E does create what's called phantom income tax, meaning that the tax is levied on income that was never received. In the cannabis industry, that amount can be staggering. So I think the idea here is, let's say they grew a lot of cannabis, but they didn't end up selling it right away, or say in that given year. They would want to try and put an amount of tax on that had they been able to sell those goods for a cost, and what that cost would have been, a tax applied to those numbers, which is just crazy. But the truth is, the IRS can't collect tax from the business if it can't pay it, because the IRS cannot seize and sell cannabis, thankfully. But it is more than that. Our income tax system is pay-as-you-go, meaning when you receive money, you pay tax on it through paycheck withholdings or quarterly tax payments. Section 280E is different. There's no income with the assessment of the tax. As a result, I have many cannabis company clients that owe millions under 280E. They might never be able to pay those tax bills, and they might not have to. Our tax system, the rules, and the IRS authority are all specifically geared under the 16th Amendment to determine income or gain on which the tax is applied. So just to jump over, what is the 16th Amendment? It is the amendment to the U.S. Constitution ratified in 1913 and allows Congress to levy a tax on income from any source without apportioning it among the states and without regard to the consensus. So imagine that. They want to keep all this tax and not have to give it back to taxpayers or put it into infrastructure or schools or reinvestment into communities. They just want to keep it for themselves. The determination is simple with a salary. Your paycheck is income and tax is applied and withheld. But in a business, it's more complicated. A business that sells a product is made up of different types of assets: goods for sale, equipment, and the business itself. The costs that a business incurs are accounted according to the life of the asset to which they relate. Thus, the cost of equipment is deducted over the useful life of the equipment. The cost of acquiring or producing a product is deducted when the product is sold. But there are also ordinary and necessary costs of running a business that are not directly related to the product cost or equipment. These costs are called ordinary and necessary because they are the legitimate costs of building and operating a business itself. As such, deductions for these costs could attach to the business itself and be taken against the income of selling the business. But the tax code allows deduction for the ordinary and necessary business expenses against current income, rather than when the business is sold. The difference is timing of when the tax is applied. 280E bars cannabis industry deductions. So for cannabis companies, 280E bars deductions for ordinary and necessary business expenses. But what happens to a disallowed deduction? Wouldn't the ordinary and necessary expense just revert back to being attached to the business itself, to basis in the business? Basis can be complicated, but essentially it's an owner's contributions to a business that, when returned, are not taxed. It's kind of like a down payment on a home. So think if someone wants to start their own cannabis company and they have enough money to start the initial funding, they can put that money in, and obviously the hopes of growing the business to get a return on investment, then they'll be able to take that money out without being taxed on it. Our system taxes gain. Our system taxes gain. If the disallowed ordinary necessary expense is allowed as basis, then the requirement is satisfied. If not, the Section 280E is a violation of the 16th Amendment. I've had a number of discussions with the IRS and tax professionals regarding the position, and it is hard for anyone to dismiss it out of hand because an ordinary necessary expense can't just disappear, and it makes 280E and the 16th Amendment work. That said, the tax code also includes rules that are problematic to the concept that a disallowed deduction should increase basis. In fact, some rules deem disallowed business expenses are personal and they actually reduce the owner's basis. So that would actually be taking eventual future profits from that down payment made by the owner to start their own company. But those rules deal with expenses that are not ordinary and necessary, and I would say are not required in the determination of gain. And so 280E fails to level the playing field. When I was an IRS trial attorney, I took an oath, like all IRS employees, to treat all taxpayers equally and fairly under the law. But there are numerous examples where 280E produces incongruent results. For example, the U.S. Tax Court recently held that cannabis stores cannot capitalize the packaging expenses that the code requires for every other type of businesses, including cannabis growers and manufacturers. Cannabis growers are hardly impacted by 280E at all, while medical dispensaries are severely penalized. How terrible! Because medical dispensaries are providing an alternative medicine that doesn't kill people and actually relieves their suffering, and they get affected by this the most. Just ridiculous. The same expense in the hands of a grower is deductible, but for a reseller, it is treated as taxable income. So they just treat medical cannabis dispensaries as drug dealers. For example, equipment for a grower is allowed, but not for a store. And the simplest act of forming a cannabis business as a C corporation or LLC determines who ultimately owes the phantom income tax. If the company is a C corp, it owes the tax, but generally, if the company is an LLC or S corp, the phantom income tax is the owner's personal liability and can be collected from the owner's personal assets, home or income. Perhaps most disturbing is that 280E drives up the costs of legal, regulated cannabis, making room for the illegal market to compete and increasing the price of medicine for people who really need it. So is that why cannabis is so expensive still? Because the government doesn't want to shut down the illegal market? Wonder if it benefits them. The truth is, 280E turns our tax code upside down and does not meet the needs of society. And that is just the highlight of this. It's a fact. It does more harm than good for most people. The IRS should make clear that the ordinary necessary business expense that cannot be claimed as a deduction or cost of goods sold, COGS, under 280E is an increase to basis in the business. Which brings us back to the reality that 280E is really about timing. The government has the authority to determine the timing of a business expense, but it cannot take it away forever. If this approach were adopted, it would mean that 280E is not unconstitutional because gain under the U.S. Constitution would be determined on the ultimate disposition, sale, or failure of the business. Good news for the cannabis industry, perhaps better than legalizing cannabis if legalization replaces Section 280E with an excise tax. Moreover, this solution would not reduce the effectiveness of 280E on illegal drug dealers who would unlikely be able to sell their products even if they are incorporated. And sadly, due to state law, they're not drug dealers anymore. They need to get out of this old school, ridiculous mindset. And it also would resolve collection issues for the IRS, as the agency could wait until a business was sold or failed to true up on 280E deductions to accurately reflect any gain. So There does appear to be small business exceptions, so these would be for the smaller mom and pop cannabis operations. Finally, there has been a lot of talk with the small business exception to the inventory accounting rules, Section 471C of the Federal Tax Code. The small business exception is again just timing, except Congress took away the IRS's power over timing and specifically provided that all small business taxpayers have the authority to determine the timing of deduction. So at least for small businesses, the power is in the business owner's hands to apply the timing as opposed to the IRS. And perhaps, predictably, the IRS recently included a statement in its regulations that could remove the benefits for the cannabis industry. This is another example of how the politics the industry faces because the IRS statement directly contradicts the statute, the intent of Congress, and its authority under the 16th Amendment, which is ridiculous at this day and age. I work with the IRS every day, and I know many of the agents understand these problems and wish the IRS would do something about them. Unfortunately, there are others who seem to enjoy their problem and flexing with their 280E muscles. And this is the thing with any big bureaucracy or big organization. There's always going to be the larger majority that conform and just do what they're told and collect their paycheck because it's easier than having to go against the grain. And then there's that smaller amount that have integrity and, value their credibility over everything else that are like, no, this is unfair, this is wrong, this needs to change. And that's something worth pointing out that, again, that's always usually the case. But at some point, when you have the case to make, that smaller group can prevail. Unfortunately, and past that one, the IRS should remember its oath. Absolutely. They swore under law. Put its politics aside, stop targeting the cannabis industry, and stop betting the 16th Amendment in its war on drugs. The war is over. The industry is here to stay. Prohibition is lost. So it's time for the IRS to get caught up with the times. So, folks, if you understood some more of this and want to relay some comments below, let me know because I'm not, it's very complicated stuff, but I would love to have a discussion because obviously this is ridiculous, but I do have to highlight how much further ahead we are in this fight. Prohibition is definitely going to be in the rearview mirror. And again, just great to highlight that we have professionals working in our favor that also want this fixed because it does way more harm than good to the American people. So if you enjoyed this, please leave a thumbs up on it. Subscribe if you don't want to miss any future videos. And I will be back on Sunday for the next episode of This Week in Cannabis. Have a great weekend, everybody.